They just turned 50 and they want to pay off their home loan in the next 15 years before they retire. But the problem is their home loan is still $720,000. I'm going to quickly show you how they can pay off the home loan in the next 15 years. I'm your host, Tony Shah. Thanks for joining me on another episode of The Mortgage Chat. So everybody, check this out, okay? So this is not just for your older generations that wants to pay off the home loan before they retire. This strategy can be applied to any age group, all right? Unfortunately, this couple are a little bit older. They didn't know how to invest. They accumulated more owner-occupied debt without thinking it through. So I'm here today to show you a plan that we're going to put in place for these clients, how they could pay off their home loan in the next 15 years if they invest in the right asset. So guys, please jump online, jump on YouTube, look at this video because I'm going to show you on an Excel breakdown how we can potentially do this for these clients, okay? So please jump online right now, just watch this part and you can go do whatever you want and listen to this podcast, all right? Okay, everybody, so here is the second part of the video where we are putting this plan and breakdown for our clients, okay? So like we said to you, their existing loan is $750,000. Now, equity is actually not an issue because their value of the property is around $2 million, all right? So we put a plan in place where they will only go up to a level of debt where it's not going to affect their lifestyle. So this is what this exact scenario is, all right? So what we've done here is we are refinancing the existing loan of $750,000, right? So they were around 0.2% off market. Now, this right here is after the recent rate rise in February 2026, okay? So that's why I've adjusted everything here by 0.25%. So what I've done here, against the owner-occupied property, they have one loan for $750,000, which is the original loan, and we're gonna take out $230,000 as equity, okay? So this will be used as a 30% deposit plus stamp duty. Now, because this is still a loan, right? So equity is still a loan. That's why there's a repayment here. And we've done it as interest only. And the reason why we do it as interest only, because you want to pay off your owner-occupied debt first because that's non-tax deductible, right? So you want to keep all your investment loans that you use for investment purposes interest only, because you want to claim the tax deductions on it. So therefore you get a bigger tax return back at the end of the financial year, okay? So I'll break that down in a second, all right? And there's a reason why I took out $230,000 because we're going to buy something for $660,000, okay? You'll see here the end loan is actually just under 70%. And the reason why we want to borrow 70% against this property is because we're going to get a better rate, okay? So normally at an 80% loan, this will be around 0.1% higher. But because we're borrowing 70%, we're getting a reduction of around 0.1%. And that's why I did it, right? So that $230,000 comes from here. And this will cover the 30% deposit of $660 and also the stamp duty and solicitor costs and BA costs and property search costs. And we're assuming they're buying in Tasmania, right, for the higher rental yield. So that's the breakdown. And we kept it at $660 plus the cost is because that is the loan amount they're comfortable with without affecting the lifestyle too much. So the original $230,000 will come from this property, and we're going to borrow the remainder, which is $460,952. Okay, so that's just under 70% of that. Now you'll see here the breakdown over here, the cash flow, right? So the loan here comes from here. Okay, now we're going to work out the cash flow for this loan only. At 5.85% interest only, that's your repayment. Now we're going to get a higher rental yield property with around $610 a week. That's your monthly rent. We like to take away 30% for expenses. Like I said to you, it could be 20, 25, 30, but we like to keep it as 30% just as a guide, okay? So it could be property management fees, water rates, council rates, insurances, all the shebang, okay? So 30% of your rent minus that, from the monthly rent, your net rent after expenses is $1,850. Okay, so that net rent minus your repayment for this loan is $392 and some change, all right? But remember, you got to account for the equity loan as well because you borrowed that, right? Because you're borrowing 100% plus costs because we are not using your own savings for this purchase, okay? So therefore, the total cash outlay for this investment property, is actually that $1,512.30, right? So it's literally that plus that. You'll see it down here. Okay, so that's how much it's going to cost them every month to hold the property and yearly to hold the property. Okay, now the total debt repayment, including the owner occupier, is just under $5,000 $900 per month. That's just the fixed cost from the two properties, okay? The good thing is they're on a decent income because the kids are not living with them anymore or they're self-sufficient, okay? So therefore, if she's on 120 and he's on 96, that's their take-home pay after tax. So they got around $13,771 to live off every month. So that minus that, that's the spending money. Okay, so that's the net disposable income they can live off every month. So I don't think they're going to use the whole amount, right? So, you know, they'll be leaving some money for a rainy day in savings in the offset account, contribute it into the super to reduce the taxable income, or that they can do whatever they want. But remember, they're negative geared here, right, by $18,147.60 per year. So obviously there's going to be a tax refund on that when you do tax returns, right? So I'm just assuming it's 30%. Based on that, they're going to get around just under $5,500 every year as a tax refund, not including depreciation, obviously. So that really much equates to around one a bit repayments they're paying off extra from the tax returns, or they can use for holiday money, whatever they wanted to, okay? So this is the juicy bit, okay? This is where we are showing them, hey, you know what? A mixture of you paying down your home loan organically before you retire, call it the next 15 years, and that property doubling in value can actually pay off this home loan when you sell it a lot faster before you retire, okay? So I'll show you how. Now, so in this scenario, okay, the loan is $750, the loan term is still at 28 years, and we're going to jack up the rates to 6%, okay? So if they were to retire in the next 15 years, they're going to pay down their home loan from $750 all the way down to $500, all right, and some change, okay, organically. So this is just making your bare minimum repayments. Nothing in the offset account, no extra repayments, which we know they are going to make extra repayments and money in the offset account. Okay, so that's just a bare minimum if they were to make the minimum repayments every month. All right, so let's break down how they can use the investment property to pay off the home loan faster. So as you can see here, we purchased something for $660. So what we have here, right? So we are assuming the investment property will double in value in the next 15 years before they retire. Okay, we are hoping so anyway. All right, so obviously, you know, profits, capital gains, you have to pay taxes on it. So this is what we've done here. All right, so right now you get a 50% discount on capital gains if you held the property for more than 12 months. But the other 50%, you have to pay taxes on it. So in this scenario, remember, we are assuming the property they bought in Tasmania for $660,000 will double in value in the next 15 years. Well, we're hoping it will double in value anyway, right? So that's the whole point of investing, okay? So, you know, the property cycle runs at every 8 to 10 years, okay? But because the prices are going up so high, so fast, we're going to give it 15 years now, okay? Just as a really worst case scenario assumption, okay? And we're assuming they're going to buy a very, very, very good asset, okay? Now, we're assuming here, $660,000 profit, okay? Now, obviously, when there's a profit, you have to pay taxes on it, all right? So right now, you get a 50% discount on your profits for CGT, okay? So $330 is tax-free, which is fantastic, but the other $330 will be added onto your taxable income, okay? So in this scenario, if I go here, right, that divided by 2, so that when they sell it, $165 will be added onto her taxable income, and $165 will be added to his taxable income. Now, down here, this is where I'm assuming, okay, they're going to pay the highest marginal tax rate at 47%. So therefore, they're only left with just under 175 grand after taxes for that portion of 330. So that plus that, guess what? After the sale of the property, and I haven't accounted for, you know, example, selling costs or solicitor costs and all that, okay? So let's just call it 30 Gs, right? But for now, let's just assume. So right now, just assume, okay, that's covered. Let's just assume covered for argument's sake, okay? So remember what I've done here, right? Remember what I showed you. In 15 years' time, okay, their loan will be more or less $498,008. So this is the profits. Okay, this is the profits right here. So remember what I said, right? In the next 15 years, if they make bare minimal repayments by the time they retire, their loan is going to be around $499,000 right down here. Okay, and guess what? They're going to profit $504,900 from the sale of this property if it doubles in value in the next 15 years. Whoa, hey, guess what happened? That minus that, bang, they paid off the home loan if they invested in the right asset. So that's how some people pay off their home loan a lot faster, right? Especially if they buy good capital growth properties. And that's how I've paid off my home loan in less than 10 years because I invested in a great asset that grew in value and I used the profits to pay off majority of my home loan. While at the same time, in the first 7 or 8 years, I was smashing that repayment down with the money I have in the offset account and also making the move. And that's how I paid off my home loan in 8 years, right? Because I invested in one great asset that allowed me to sell make a big profit and paid off majority of my home loan, okay? But at the same time, also had a lot of money in my offset account that reduced my interest for the first 8 years that allowed me to pay more principal and less interest repayments. So in a combination, I paid off my home loan within the first 8 years, all right? And look, you'll see here, okay, this is assuming the investment property stays at the same rate for the next 15 years, okay? So at the same time, in the next 15 years, they're gonna get a tax refund of that much amount, right? So what I've done here was 15 times by that. That's your tax refund. So for negative gearing purposes, they're also getting 81,668, okay? Now, the lady did make a great example. They go to, well, Tony, what about if I don't invest in this? What about if I don't invest at all? What about if I just make my minimum repayments and instead of investing in an investment property where I have to fork out 2.3 out of my own pocket, what about if I just put this in the offset account or made extra repayments of around 3? Oh, I'll show you. All right, so as I punched it here, right? So instead of pulling out $1,512 out of their own pocket every month to pay for the cash outlay to maintain that investment property, they could pay that extra money into the loan or into the offset to reduce the taxable income, which is correct, right? So as you can see here, 750, 6% over 28 years, you're paying this amount into your offset account or extra repayments every month. Do you know what? You can still pay off your home loan in just under 16 years, right? So it works out the same. But if you do a comparison into that, right? Guess what? I'm getting my tax refund back as well. Remember that. So over the next 15 years, I'm getting an extra $81,664.19 in my back pocket, right? And also I haven't accounted for depreciation that I can claim back to reduce my taxable income. So this amount here will be greater than $81,664.19. Okay, so you've got two ways to do it. It's either you do down the investment part where you can reap the benefits of negative gearing and depreciation and you get a little bit more back, okay? Or, do you know what? You can just go to over here and you pay extra into your loan and you can reduce your loan term from 28 years all the way. You can reduce your loan term from 28 years to, call it 16 years. Or you can go in here and reduce your loan term from 28 years by paying extra repayments every month down to 16 years. Okay, so you've got two ways to do it. This one's probably less risky, but this one here allows you to reap the benefits, right? And I'm assuming this property only grows by double in the next 15 years, right? Could be a bit more. If it grows a bit more, then guess what? You're gonna have more change in your back pocket to live off, okay? So this is just assuming it goes up double in value only, all right? So there you have it, guys. This is just a quick example. But remember, only use this as a guide, okay? It's not financial advice, it's just a guide I've done for one of my clients and they are only using this for educational purposes. Okay, guys? Not financial advice. So there you have it, everyone. That's just a quick guide on how these clients can potentially pay off their home loan in the next 15 years or before they retire. And they can do so by investing in one great asset, okay? Now, I've made a few assumptions. The rates were going to stay at 6%. And additionally, we are assuming that the investment property they're going to invest in will double in the next 15 years. So that's a big assumption right there, okay? But the thing is, we can never predict how much the property is going to grow by in the next 15 years. I'm just using the next boom cycle of 8 to 10 years where potentially the property will double in value. And if it does, these couple can retire pretty comfortably without digging too much into the super to pay off their home loan. So there you have it, everybody. Once again, thanks for joining me on another episode of the Mortgage Chat. And please, again, look at our other videos, especially the one on how to invest in your SMSF up here, because that's been very hot lately, especially when people want to generate more wealth within the super instead of leaving it in the industry super fund. But with this strategy up here on this video, you always have to talk to a financial planner or an accountant to make sure an SMSF is the right vehicle for you. As always, thanks for joining me and we'll see you next time.